as we said, as Kathleen indicated, a lot of things can still go wrong. What are you positioning for?
I think it's fair to say that Tuesday marked a very inauspicious start to Wall Street for 2023, and I think U.S. even though U.S. shares attempted to trim losses and are still trying to trim losses right now, I think demand jitters are likely to define the market and macro milieu for the foreseeable future, and this is one of the problems. There's a lot of uncertainty again. If we actually had at least even a less cloudy looking glass view into what's going on right now, I'd feel a lot more comfortable. But for index huggers like myself, or people that buy indexes like myself, it's very, very difficult here to see any low-hanging fruit. What are we going to do? And that's going to be a big problem as we get through this orientation period, as I call it right now in the markets.
Recession calls, Stephen, coming from just about everywhere. We heard it from Bill Dudley, adding to calls from the IMF saying, you know what, U.S., Europe, China will slow down in tandem, paving the way for perhaps a global recession. Where should smart money go to? What will do well despite a recession?
How about cash? Is that a really bad strategy for the first little while? I mean, I think it's the best that the money put right now. But if you ask Bill Dudley, and I think that was a fantastic interview he did on Bloomberg, and the U.S. recession itself is getting created by the Fed. So the opportunistic take here, and he correctly pointed this out, and this is at everybody's back of mind. Will the Fed reverse it quickly by dropping interest rates? I think it's an unlikely prospect, given one, that inflation is likely to be above the Fed target as we enter the later half of 2023. I think it's going to be well north of 3%, and this is going to create a significant problem. My fear here is the markets will still be talking about rate hikes at the end of 2023, and that's a problem. And in a rate hike environment, stocks just don't do well, as we saw valuations drop by the increasing yields last year. But here's the big problem, Haslinda, and this is what I'm really worried about here. We're moving off the high yielder knockdown on stocks, and we're moving to the potential destruction of earnings, and this is a real worry for stock pickers as the lagged effects of the Fed policy start to weigh on a wide spectrum of stocks.
You say that China is a buy with its reopening. What exactly is looking attractive in China?
Well, I think there's a few things. I think the accelerated reopening has probably caught a lot of people by surprise. I think everybody was expecting maybe an end of Q2, and now it looks like it's beyond the fast track to the COVID policy off-ramps right now. But judging by media reports and observations from boots on the ground, new COVID cases in populous centers in China appear to have peaked, and this is quite good. I mean, let's face it, they're still at miserably high levels. And this is one of the problems with the markets, really, when you think about it. We have no concern about people's health. All we care is about things accelerating positive for the markets. And unfortunately, that's a side effect of what we're seeing right now. Look, we've got green shoots in mobility data opening, although PMI indexes were still markedly weak. Policy messages have been very, very consistently pro-growth. And I think this is really what's spurring on some adventures here in stock markets. We're looking at Hong Kong today, and it's just don't show up late for the party.
Well, the thing is, there's so much optimism pinned on the pledged stimulus by China, but you got to wonder how much China can actually do, given the economy has been in doldrums for the past 3 years, and land sales have been pretty meager. There is pretty limited funding at hand.
Yeah, well, this is another interesting part that we're looking at. We're looking at, the PBOC and policymakers themselves trying to, internationalize the yuan to attract that foreign direct investment. I mean, they're opening the hours to allow trading. That's a very big positive. We think this is going to continue to resonate, and this is part of what we're looking at, a gradual appreciation of the yuan. I think everything is pointing quite good, but one thing that we always remind our investors, and why we look to take profits on peaks and then re-enter on dips, is simply the fact that the data hasn't turned. I think my view here is we're going to have to see a convincing turn in the US or in the China economic data to really reaccelerate another spurt higher. Without that growth impulse passing through to or growth sentiment impulse passing through the data, I don't think we're going to go much higher than we're seeing right now.
Some say, Stephen, that the path of least resistance for the yuan is actually to the upside, but you got to wonder how the PBOC views it. A weaker yuan would be better for an economy that is slowing down, isn't it?
Definitely, but they've got a little bit of help here from the Bank of Japan. Well, at least from the implications that traders are taking of the Bank of Japan that are changing their policy a little bit. The stronger yen allows the yuan to weaken on a competitive advantage basis. So, sorry, let me rephrase that. Allows the yuan to strengthen on a competitive advantage basis, and this is okay. So they see this from a basket perspective, not necessarily straight up against the U.S. dollar.